Good morning and welcome to this Monday, March 15th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, first we've got futures, a little mixed, once again favoring the Dow. Currently, we've got the Dow Jones futures up 43 points. S&P futures down 4, NASDAQ down 13. So again, a little bit of a mixed morning, but not too big one way or the other. So I think we'll get off to somewhat of a quiet start. It's a pretty volatile week last week. And we're going to get into all of that in just a moment. But first, go ahead and take everyone over to Earnings Beats. If you are new to Earnings Beats, love to have you check out our Earnings Beats Digest. It's a free newsletter. No credit card required. You can unsubscribe at any time. Simply go to earningsbeats.com and then type in your name, email address here. Hit that subscribe button. We'd love to have you join. Talk a little bit about earnings, relative strength, breakouts. Talked a little bit about that in an article over the weekend. And then also this morning in the Earnings Beats Digest was a company that finally broke out to a long-term high. So some pretty good, I think, trading opportunities that are featured in there as well for those of you who like to trade. Love to have you join us for our regular paid service. There is a no-cost 30-day trial. You can simply click on that green Join Today button. We will charge you $7 up front, but then we refund it to you within a week. So there's no cost for 30 days. Seeing some comeback in our portfolios. Portfolios got off to a rough start, and we'll talk about a couple of the reasons why, but primarily it's just a lack of interest in growth stocks right now. There's been much talk about inflation, higher interest rates, and so I think it's the reason for having some rotation in the market. Rotation in the market's actually pretty healthy. As I've talked about for the last several months, I wanted to see those value stocks come back. I think that's a really good sign for our economy. And that began really with the vaccine announcements back in November. But as the vaccines rolled out, we're seeing a lot of money rotating back to many of the areas that were hit hard during the pandemic. Small caps, mid caps, which were really hit to the downside, they are on fire right now to the upside. So all of this, I think, plays into a much more bullish theme long term, which is good no matter what side excuse me, what side of the aisle you're on, whether you're looking at growth stocks, value stocks, small cap, large cap. I think they're all going higher. I think the challenge going forward is going to be what outperforms. And that's where we'll be looking for, once we get past this initial stage. This is kind of I don't know what the right word is, buoyant. But a lot of folks are really excited about many of these companies reopening, if you will. And I think that's driving a lot of the short-term action in the market right now. But I think things will stabilize, and we'll have a much better picture here in the next couple of months as to what we really believe is going to be the areas that you want to focus on going forward. Personally, for me, I think interest rates are going to remain low. I'm not saying they're not going higher. They're going higher. But again, you can't look at interest rates and say, well, they're soaring because of last year. Well, they are soaring because of last year, but they're down. Historically, they're still at extremely low rates. This is very conducive for companies that are trying to grow because capital is so accessible and it's so cheap. So I don't think that's changing. So the question is there going to be inflation? Now, I did write an article over the weekend about it, and I've talked about it. I don't believe inflation is going to be a problem. I think it's going to be a headline problem for the next few months, and we'll get into all that. Let's just go ahead and first take a look at what happened on Friday, and we'll get into some more of that in just a minute. So we had the Dow Jones Industrial Average up another 293 points, 32,778. When it went through 32,000, I said, well, here comes 33, 34,000. I'm not kidding. I think the Dow is going to explode this year. I think the Dow could hit 40,000 before the year's out. Wouldn't shock me. But I would say 38 to 40,000 is probably a reasonable target on the Dow. S&P 500, 39.43. It was up 4 points on Friday. That's a new closing high. We'll talk a little bit more about the S&P in just a few minutes. The NASDAQ going the other way. NASDAQ struggling right here at these moving averages. And I think short term, this is where we've got to be a little conscious of what's going on. So if you're trading these growth stocks, many of the growth stocks, technology, consumer discretionary that we find on the NASDAQ. I think if you're in those areas and you're trading, I think you got to be a little nimble until we break back up above these moving averages. I think when we break above the moving averages, then I think we're heading back to 14,000 and higher. But do we have another leg down? I don't know. It's March. This is when historically we do see those types of companies, growth stocks, technology, taking a back seat. This is history. This isn't just 2021. And I've been writing and talking about it a lot, but the third calendar month or the third month of each calendar quarter is when the market tends to pause. The growth stocks tend to pause. You got NASDAQ, technology, all of that area tending to pause while money rotates into more defensive areas. And then the next month, as we get into earnings season, it flips back. That's the history of the market. Mid caps, as I was mentioning, mid caps, small caps, look at them just taking off to the upside. They look very similar to the Dow. So the areas of the market that were hit the hardest during the pandemic are the areas that are bouncing back the nicest right now. Short term, yes, this is a problem for growth stocks. Long term, I don't believe it is. Again, I think everything goes higher, and I believe the growth stocks will lead. I think in the second half of the year, I think growth is going to pick up. I think everything's going to do well, but I think with still reasonably low interest rates and the kind of growth that I'm expecting, I don't think growth is going to be 4.5%, 5%. I think it could be 6% or higher. If GDP is 6% or higher in the second half this year, and our rates are still reasonably low, I don't think growth stocks are priced for that. I think they're priced well, and I think they're priced for continuing expansion, obviously, of earnings, but I don't think they're priced for that kind of growth. And so I see them going higher. But short term, I think we have a window here that we got to be careful. And true to form, in March, on Friday, we had real estate leading, utilities, industrials, financials, and staples. Where's technology? Where's consumer discretionary? Where's communication services? They're not in favor right now. And so we've had a day or two here or there where they've led, but for the most part, those charts, especially technology, look a lot like that NASDAQ chart right there. We're trying to get back through some moving averages. And until we do that, I think you've got to be a little bit more cautious. I think the safer plays right now are probably trades anyway, are in the Dow, the S&P 500 outside of technology. I think that's, and certainly mid caps and small caps. Whoops, sorry about that. So yeah, that's kind of what happened on Friday. I mean, we had defensive areas leading the market along with financials and industrials. The 10-year treasury yield took a big pop higher on Friday, jumped about 10 or 11 basis points to 1.64%. Today it is down 2 basis points to 1.62%. So it's coming back down a little bit, but this is an unmistakable big move to the upside, which favors areas like the financials. So that's one of the reasons why we're seeing banks doing so well, life insurance, many of those areas that tend to struggle when the yields are down and the spread is low. Those areas are really bouncing back right now. And the best way to see it, let me show you the relative strength of the industries. Let me go through some of these financials for you. So this is a relative strength chart of all the financial areas. So first, property and casualty insurance. So this is a weekly, 3-year weekly chart. And this is how property and casualty insurance was performing. You can see during the pandemic. This isn't just the group going down. Down here is where you see the group going down on an absolute basis. This means that it's going down relative to the S&P 500. So while the S&P 500 lost 35%, property and casualty insurance was down a lot more. And you can see it was up at 1,000 and it fell all the way back down to 640. So that's a little over, that's probably 37%, something like that, 38%. I don't remember what the S&P 500 was during this one period right here, but, and it's not exactly lined up, as you can see, the highs and so forth, but pretty close. But the point here is property and casualty insurance took a big hit on a relative basis to the S&P 500. It's been stabilizing, and now look what's happening, starting to move back up. So we're getting strength in areas that we weren't used to, and you'll see that on a number of these financial charts as I go through. Here's mortgage finance. Mortgage finance takes the big hit in March, been steadily working its way back up. On a relative basis, relative to the S&P 500, This is now at the highest level it's been in a year since this time in March last year. So again, money rotating. These are the areas that money is rotating into. Insurance brokers, not so much. We had a little bit of a pop January and February. March, it started to turn back down. This is still not a great area within the financials. The financial administration area has been pretty strong all along. Little hit there during the initial stages of the pandemic, but since then, this has actually been a group that's done very well. Reinsurance, once again, downtrend, but it's now broken out. It's at about 11-month relative high. You've got consumer finance. Look at consumer finance, which was absolutely falling apart back in January. All of a sudden, come to life here in just these last, 2 months or so. Next up, investment services. Now, this is one of the stronger areas within the financial sector, might be the strongest along with banks, but you can see investment services since that vaccine news came out in November, been straight up. This has been a very, very strong group. So stocks like Goldman Sachs, Morgan Stanley, and so forth, benefiting. Full line insurance. You can see again, breaking to a 1-year high. Look at that relative PPO above the center line and rising. That's telling us that the momentum is very strong in this group. So if I find a stock that I like in a group like this, I have more confidence than if the group is losing on a relative basis, because it's telling you more and more money's coming out of a group if it's declining on a relative basis. That's going to be less money to drive your stock higher. But if you're in a stock that's part of a group that's doing this, you got more and more money rotating into the group. So those are areas, those are stocks that you might be more interested in. Here's the banks. So I showed you the investment services. Look at the banks really since the September low, but especially since the beginning of November, straight up. And this is corresponding not only with the fact that, we're getting the vaccines rolling out, but it's corresponding with the surge in interest rates. That spread, which is so important to a bank. I audited banks when I was in public accounting. And I can tell you there's nothing more important to a bank than seeing the yield spread widen by a big margin. I'm talking about the long end of the bond yield or bond versus the short end. As that spread widens, bank profits soar. So that's why you're seeing the banks doing what they're doing right now. Then you've got specialty finance, which is just starting to turn back up again, but it's been in a downtrend. It was actually very strong during much of the pandemic, but turned lower. And now in January, looks like it's found a tradable bottom and trying to turn back up. Still not nearly as strong as some of the other areas. Then you've got asset managers, kind of fitting in that theme with investment services and banks. You can see the asset managers moving now to about a 13-month, 14-month high, relative high. So another group looking good. Life insurance, look at life insurance, absolutely starting to soar. This is another area of the market that does much better when that yield spread really surges and widens. And you can see just like banks taking off in November. And I think that is it. Yep. So those are the areas of the financial sector. And I thought it was pretty important to talk about that a little bit. Now, as far as getting back to that 10-year Treasury yield before I got sidetracked there, we do have, today we had one economic report that came out. The March Empire State Manufacturing Index came in at 17.4. The market was looking for 14.8, and February was 12.1. So we beat last month by a pretty wide margin, and we beat estimates, but the yield nonetheless has dropped a little bit, down 2 basis points today. I do want to mention also tomorrow morning, we have February retail sales coming out. Remember, January's report was massive, up 5 3/10%, I believe. Just checking in my notes here. Yeah, 5 3/10%. February is expected to drop 0.5%. So after that huge January, we're looking for a pullback in the number. If we strip out the autos, February retail sales are expected to be down 0.3%. In January, that number was up 5 9/10%. So we are expecting retail sales to pull back. I imagine if we see sales better than expected, if they come in positive for February, that's probably going to send the yield up again, and just kind of magnify some of the rotation that we've been seeing in the market. If it comes in lower than expected, we could see that yield pull back and maybe some of the growth stocks rebound based on that. I still think we got another couple of weeks here to try to get through with the growth stocks. All right. I did write a couple of articles over the weekend. So wanted to just point those out to you. One was the rising inflation, talking about the inflation. So if you'd want to go back and check that out, I'm not going to go through the whole thing, but what I will just point out, I said that the headline numbers are going to be really high over the next few months. The reason, and if you look at the last 12 months, if you just add up the 12 months, you can see what inflation has done. But when we take out March, April, and May, which they all had lower core CPI readings during the pandemic, we're going to replace those with numbers. And you can see January and February up 0.3, up 0.4. When you have March, April, and May going up anywhere from a couple tenths to maybe 3-4 and you replace those minuses, you're going to see the core inflation year over year number really spike well above the Fed's 2% target level. It's coming. It's almost a mathematical certainty based on what's going to drop off and what we're going to add. I cannot see the core CPI going down the next 3 months. Even if it's flat, we're going to add another 1.1% over the next 3 months. So get ready for the headlines. The headlines are going to be out there, and it's probably going to have an impact short term, but I think it's going to be an opportunity. So if we know it's coming and we see it happening as a trader, we should be able to take advantage of some of that. So I'm actually looking forward to some of these reports and what may happen. But I think heading into the reports, you better be careful because there could be some selling leading up to the reports, and the headline numbers could certainly trigger some selling over the next few months as these numbers come out. Next month, you're going to see probably the core CPI move back up near 2%. But in April, when we lose that 0.7% drop, you could see it all of a sudden shoot up close to 3%. Now that April number will be out in mid-May. And that's going to be about the time we get past earnings season. I think things will probably be great for earnings. It's also going to probably be close to option expiration. I haven't looked at the dates yet, but that's going to be very interesting if growth stocks do well. And all of a sudden, we have a CPI report coming up and the headline number's huge. That might be something that takes the market down, especially with options. So all of that coming together is going to be very fascinating. But we got a long way to go to get there. But just keep in mind that these headline numbers are coming. The other article that I had written was just a couple of breakouts that I thought looked very interesting. Just point out the charts here real quick. Dropbox, you can see making a breakout. This wasn't just a breakout, though, here on the daily. I mean, if we go back and we pull up the 5-year weekly, you can see going back the last 2.25 years, this is really the first or the steepest move above, say, 26, 27 that we've seen. So I think we're in a nice uptrend on a weekly chart. Look at the nice tests of the rising 20-week moving average. See how before when we went up, we lost it, went back down again. Now we're breaking to a multi-year high. We're showing very positive signs on this weekly chart. I think Dropbox looks pretty good here to me. And let's see what the other one was. Embraer Aircraft, ERJ. I do want to mention ERJ reports earnings later this week. I didn't mention that in the article, but I did notice it when I was looking through the earnings. So just be aware of that. I think it might be Thursday, but double check me on that. I'm not positive which day I saw it. But ERJ, I do remember seeing reporting earnings later this week. But this is another one. Look at this nice breakout. Now, this has been in more of an uptrend. But when you look at the weekly chart or the longer term chart, you can see the breakdown. See all these bottoms right in here above $16? I mean, we had years of really good support just above 16 and a half. When the pandemic hit, it was straight down. Now that we're seeing this volume come in and we're at 10, I think this is a stock that could run to 16 fairly quickly based on how fast we lost that. And if we're truly, returning to normal, things are starting to get, more go back to normal. This is a stock that easily could go back to its $16 level, and it's sitting at 10. So it's not breaking out to an all-time high, but I think it's a breakout to at least be aware of. Now, it might be volatile. It's got a lot of volume. It's surged quite a bit if we go back to that daily chart. Clearly, it's been up a lot. A move back down to, say, 970 would be kind of a no-brainer because that's just where we broke out from recently. The 20-day moving average is certainly a possibility. We did that back at the beginning of March. So there's still room to the downside, but if you wanted to build a position, I think this is a stock that looks very interesting. It's certainly more risky than normal. So if you're risk averse, you have problems with stocks, sleeping at night, don't look at this stock. Don't look at Dropbox. Stay away from those stocks. Maybe stick with some of the Dow components, things like that. But if you're, more prone to take a little bit of risk, then I think a stock like ERJ or Dropbox looks pretty tempting. All right, let's talk a little bit about this growth and value. This is a daily chart of the IWF relative to the IWD. And if you're an Earnings Beats member, or if you've been following my shows for a while, you've seen this plenty of times because I like to focus on this. So it's the iShares Russell 1000 Growth ETF divided by the iShares Russell 1000 Value ETF. So it's just a basket of growth stocks and a basket of value stocks. And you just look at the relationship to see what is being favored. Now, we could go back 2 years or maybe even like 5 years. And you can see on this move to the upside, you can see this huge move to the upside. And we had early part of 2000, we saw a big run. Now, part of that was growth, absolutely moving, flying to the upside. But it was also, the fact that we had those low interest rates, artificially low interest rates. Growth stocks that have future, can grow their earnings. Many of these technology companies did very well. This is something I think that is probably going to continue in the future. But in the short term, I think we're feeling a little bit of that pain, some profit taking, some rotation back away from growth into value. But when I pointed this out, you could see that we had support level here at 155, another one here at 150. And so those are the two areas that I'm kind of looking for a bounce. We saw an initial bounce from 155, not a huge bounce, got up to 160, kind of rolled over. I think we're probably going to move a little bit lower today. We'll see if that 155 holds. If it doesn't, I'd be looking at 150. And if 150 fails, then I think we probably are looking for some more significant rotation, I would say, in this area. So if you're in growth stocks, you want to make sure you're sticking with the leaders if this downtrend continues. The leaders will bounce back first. Well, in my opinion, they'll bounce back first. And they'll bounce back the hardest. And I think we've experienced some of that in our portfolios at Earnings Beats. We got a lot of growth stocks. They're underperforming this quarter. But when we just got this little bit of a bounce last week for a couple of days, our portfolio came back very quickly. And most of it, I believe, is because they are leading stocks in their areas. But anyway, this is a key area and something that we need to be looking at for rotation. Now, this is just the last 20 days. The same ratio, IWF, IWD. So what we're looking at here is essentially this drop right here. So as we zero in on that drop, you can see we have really had almost no bounce. Last week, Monday, we tumbled. We came back. Tuesday and Thursday had pretty good days, but Wednesday, Friday, not so great. Friday was just kind of okay. Well, actually, Friday was not okay. Friday was the big drop, and then it was okay after the open. But what we don't want to see is big moves during the day. We don't want to see the money rotating out of value, out of growth and into value during the day. See this? This is like a trend day all day long. A couple of these other days you can see trending down most of the days. When you see that, that is money clearly rotating. When you get a gap down like we did on Friday, I don't worry about those as much. I don't like it when throughout the day, because that's truly trading of stocks. It's not opening prices. It's not where market makers decide to open prices. It's actually selling of the growth stocks and the buying of value stocks. That's what creates the intraday move. So watch what happens on an intraday basis. I think that will give us some clues as we go forward. If we have a day where that just starts up again all day long and we go back below 155, then you probably can rest assured we're not done yet with the rotation. And being in March, I wouldn't be shocked. The other ratio that I've been watching, and I'll pull this one up, is just simply the Qs versus the spider. So the NASDAQ 100 ETF divided by the S&P 500 ETF. And you see a very similar chart. So it's, growth is not favored, which means NASDAQ stocks are not being favored. And we saw that at the top of the show when I was pointing out the NASDAQ and how it's been underperforming, trying to get through moving averages while everything else is breaking to all-time highs. It's a little bit of payback. The NASDAQ was crushing the market for a long time. So I think we have to just keep all of that in mind on a relative basis. All right, let's take a look at the S&P 500 here briefly. You can see on a daily chart Friday, we broke out to a new all-time high, cleared the level that we saw in mid-February. So while we're seeing NASDAQ stocks and some other areas, growth stocks falter and not really come back much, you can see that money is coming back on the S&P 500. So everything looks pretty good there on the S&P. If we stretch it out, look at a weekly chart, you can see moving up, pulling back, hitting the 20-week, new high, breaking out above the February high, pulling back, 20-week test, another one in late November, actually just below the 20-week. Just at the beginning of March, when we had a little bit of a move down in the S&P, tested that rising 20-week moving average, moved back up. This is really good action on the S&P 500. Now, if we switch this over to the NASDAQ and look at the same chart, look at what we did last week. I know it feels horrible. This was a group that was way above its 20-week moving average. At this point, all it's done is test its 20-week moving average. Again, I know it feels a lot worse, feels like things are horrible, but if you go back to, the high that we set late August on the NASDAQ, and I think early September on the other major indices, this is kind of similar to what we did there. And if you took that as a reason to get out of the market, look at what you miss. I think from a big picture perspective, we got to keep in mind we're in a secular bull market. These major indices have not broken down. We are seeing rotation, but that's good. I mean, if the NASDAQ was selling off and that money, those proceeds weren't going into other areas of the market, we wouldn't be seeing the small caps, the mid caps, the Dow, and the S&P all at all-time highs. So this rotation is a very bullish part of a secular bull market advance. When you're in a bear market, you get one area selling off, that money doesn't go into other areas. You don't want to touch stocks. So what's going to happen is we're going to see some profit taking. And let's not forget, we got a Max Payne session coming up tomorrow night. We got Max Payne coming up. And guess which stocks have been leading this time? It's not your tech stocks. In fact, some of the tech stocks that have been hit might actually start to move higher into option expiration week this week because they've been beaten down so much. If we see the growth stocks get hit for the next couple of days, you're going to see some stocks probably well below their Max Payne levels in technology. And other areas of the market that have been flying of late, banks, investment services, even aerospace. I mean, these areas that have been flying to the upside, those companies that are heavily traded in options, we're going to have a really interesting session tomorrow night. And those of you who've been with us for a while and have been to those sessions know the importance of Max Payne. You've seen some of these stocks with the carpet being pulled right out from under them as they head in toward, Max Payne Friday, option expiration Friday, and even into the early parts of the following week. But anyway, that's the story for tomorrow. We'll talk about that more tomorrow night. So what else do we have here? Well, we're just about out of time. There really aren't any big earnings reports to talk about. They're really starting to slow down. We do have some bigger reports like Nike coming out later in the week. We've got a couple of our portfolio stocks coming up that report, one later today and one tomorrow. So if you do own portfolio stocks, I mean, from a portfolio perspective, we hold them through one earnings report. So we're not getting out. But if you trade, at least be aware that the earnings are coming out and you can decide whether or not you want to hold. Let's do the wrap up with the three you must see. I'm going to start with Alta. They reported earnings last week. I thought the stock actually, I didn't think the numbers were that bad. Alta, long-term great performer. The stock did come down. And I think just tested this breakout level here at about 305, 310. The low on Friday was 306. We held it. We gapped down, went lower, came back up and put in this doji, which kind of an indecision type of a candle, and we're above the support area. So I think as long as the stock holds above, say, about 305, 306, I think Alta looks pretty good. So that's one. Let's take a look at, well, we'll do the top 3 worst performers on the S&P 500. So let's go to Cadence. Cadence, and you can see the market just opened. So Cadence down just 12 cents right now. I think, after that big selling 5 days in a row, heavy volume, that low, where we bounced off of, I think becomes somewhat important. If we close back below 120, I would not want to hold Cadence until it starts to show some kind of positive signs, either maybe a positive divergence on the 60-minute chart, or maybe, testing one of these other support levels with a big reversing candle, heavy volume, long tail to the downside. I think that's what we need to look for on some of these stocks within software, especially stocks within software that are not leading. And if I pull up the relative chart, you can see relative to software, Cadence right now is down at about a 3-month low. So it's not horrible. It's not a 52-week low, but you can see March has been a pretty tough month for the stock. And then the last one, I think, was Lennar. And Lennar actually just coming down testing the 20-day. If you look at the home building group, which recently broke out, and this is another really good sign, I think, because interest rates have been going up. You think home builders would maybe take a little bit of a back seat when rates are going up, but they're still near 52-week high. So this tells me that maybe the market isn't thinking that we're going to see a huge pop in interest rates, because I think if we were going to see a lot of movement to the upside, I mean, if we start talking 4 or 5% the 10-year Treasury yield, then we might have some problems. But I don't think that's what this is telling us. So I like that. Lennar relative to the group was near 52-week high back in February. Whoops. Let me go back. So that was back here at this high. Lennar was on a relative basis leading. So this consolidation, you tend to see a little bit of relative weakness during a period of consolidation. And that's what we're seeing here with Lennar. I think the stock still looks pretty good. And I would expect to bounce off the 20-day. I mean, I guess there's an outside chance we're sideways consolidating. Maybe we go back down to 80. But I'd watch that 20-day. If we close below the 20-day, I personally, as a short-term trader, I'd get out, thinking that we're probably going to head down to that $80 area. But, I wouldn't be a bit surprised if we go back up and challenge the 95 area. I still think the home builders look pretty good here. All right, let's get a quick update on the market, and then we'll wrap up. So we do have the Dow up 148, S&P up 3, NASDAQ down 5. Actually, not bad action for a Monday, coming off of all-time highs last week. S&P 500 now at 39.46. The intraday high on the S&P 500, I think, was on Thursday, where we hit about 39.60. So if you're looking at intraday versus closing, I look at closing, but those of you that are looking for intraday, S&P is just a little bit below that high that was set on Thursday. But I think we're going to be seeing 4,000 pretty soon. Maybe this week. I wouldn't be surprised. So anyhow, market looks good to me. Let's work our way through this rotation, and then we'll see what we're left with as we head into earnings season. Everybody have a great day. I'll be back tomorrow over at Stock Charts TV for your next recorded version of Trading Places Live. Everybody have a great day. Happy trading.